Hey everybody, this is the Yield Coach Show, Season 1, Episode 21. I am your host, Ian Brown. As always, every episode we bring you dynamic entrepreneurs, real estate investors, business leaders, and inspirational guests ready to open up, share their story, the good, the bad, the ugly, so you can gain advantages, lessons, and accelerate your own success. A couple of housekeeping announcements. We do have our Employee to Entrepreneur e-course available. You can click the link in our Instagram bio or go to yield-coach.com. Also, our Agent to Investor ebook for real estate agents inspired to become investors. I am very excited to have today's guest, an atypical guest, and I'm excited to hear what he has to say. This is Stefan Tsvetkov.
Yeah,
did I get that right?
Really good.
Stefan Tsvetkov. And Stefan is a analytical, technical investor. And what that means is, we'll get into it deeper, but he has founded a company called RealtyQuant, and they bring data and quantitative techniques to the real estate industry. They're on a mission to add education, investment, and technology and analytics to your real estate investing. Stefan is a financial engineer turned multifamily investor. He's an analytics speaker and a webinar host. He holds a master's degree in financial engineering from Columbia University. And during his career in finance, he and his company managed 90 billion derivatives in a portfolio. He's a frequent guest on podcasts and has a very interesting approach to investment. Stefan, thank you for being on the show.
Thanks, Ian, for having me.
Can you give us, I know I just touched on your bio, can you give us a little more color and texture on your background?
Absolutely, yeah. So I'm Eastern European originally, Bulgarian. So I came to the US at 22. I went to grad school. I had a career in finance for about a decade. And I've been a real estate investor in the past 2-3 years, primarily. So I live in New York. I started with house hacking a property in New Jersey, and kind of typical strategy for somebody just starting. And then I decided to be more professional and kind of do more data-driven approach within what has been the residential space, with various strategies like condominium conversions and other strategies in the New York area. And I've been transitioning more to the commercial, multifamily space in the Midwest.
And so you have this more technical background with your master's degree in financial engineering and modeling. And did you just find that, I love house hacking and some of these entry-level pursuits, but did you find that your tools were best used on a larger platform, bringing outside money and doing bigger deals with your analytics and underwriting?
Right. I mean, at first it was useful, even to a small, even to a retail investor like myself in the residential space at the time. So it was useful because I was able to pull perhaps, let's say, 6,000 listings in the New York area and on market, off market, and kind of have them partially underwritten, and that underwriting also being done on various strategies. So let's say not just computing cap rates, IRR, stuff like that, but kind of even if I want to do a condo conversion, kind of do underwriting on that and things like that. And so it's pretty flexible. So but definitely, yeah, it's extremely useful in the commercial space. So my company actually, we've released a product this week where we do financial modeling on off-market commercial multifamily inventories at scale for any market in the US. And that's sort of an improvement over where you would have just an inventory feed that of the properties in a market and you don't know anything about them, what is being done. What I do in my own investing in the commercial space as an approach is actually modeling financially those inventories, which means, which buildings are going to have the bigger value add, and kind of doing it at scale across, let's say, tens of thousands of them, or and so forth, within the country. And so that's a more data-driven approach, kind of more scaled up approach. Now, it's a tricky thing in real estate where you want to be local, you want to have your vertical integration, even in terms of building up your team and so forth. But the approach that I follow is a little bit more market agnostic. I do try to understand the markets using data and kind of do that.
What led you to create RealtyQuant, your company?
Yeah. I mean, it's a good question. So like I mentioned, first, like I was kept building those tools for essentially my own in-house investment. So I would have automated underwriting tools. I would have even like a simple valuation model, like similar to like Zillow's estimate for like residential houses. I would have a bit of machine learning to like do condition scoring on, for instance, like property textual descriptions, kind of trying to scale automated underwriting. And so I would have like all these different models that were very useful to me. But then I guess to a point you made earlier, it is even more useful to institutions or like bigger investors or like high net worth individuals, even in the passive investing space and so forth. And so I decided to kind of scale that and make it into a technology product for others to use.
And so with the users of your website and your analytics, is it a split of like your operational general partners and then your passive limited partners? Like, let's say I had $1 million and I wanted to place it in a handful of markets that your predictive analytics say have a lot of upside or they're undervalued. Is that a way that people are using your software and your website? Because I could find an operator or a syndicator in each of those markets and spread my money around and hopefully hit nice multiples. Is that one way people are using your platform?
Right. Yeah, that's a great question. Well, currently, no. So that could be like kind of like future, like next phase or so forth. Currently, it's more of like a data service where we essentially have like coverage for whole US in terms of, let's say, what you mentioned is market valuations data. So we have for every market in the US if it's over undervalued, and we kind of pitch it as a data product. And so that has been the approach. And similarly on the property data side, so we're kind of a properties data vendor with that commercial multifamily offering that we just started this week.
Now, even with what your platform does, if it's showing kind of over and undervalued markets across the United States, I imagine a savvy investor could use it just as I described to, let's say you see a market. Pick a market, Columbus, Ohio, or some of these ones that come up a lot that have still some reasonable margin. You can buy buildings below replacement costs. Rents are rising much faster than interest rates in some markets. So, you probably could use your platform as a passive investor, and then you'd need to find your operational general partner syndicator to run the project. Now, I want to spend a little bit of time on your analytics. We spoke before the show. I started my commercial real estate career in appraisal, and I did more or less every asset class, multifamily, retail, office, industrial, some golf courses, hotel, and raw land. There's pros and cons. As an appraiser, you have to do what the bank requires as far as your assignments. So you don't get to necessarily drill into one asset class. Are you concentrated primarily on multifamily?
Yeah, I am myself, just because I guess that's my investment focus. I don't have coverage for any of like retail, office, etc. Yeah, it is multifamily exclusively. It's kind of what I understand best and focus on that for the time being.
Do you mind jumping in? I'm actually pretty curious about some of the metrics or components that drive your analytics. So like when we would go into, my company used to cover, it's not my company, it was the one I worked for, but we would cover essentially the mid-Atlantic and eastern seaboard below, kind of like below Washington, D.C. down to like Key West. And I did a lot of field work because I was the young guy. And, we would pull different statistics like household income, population trends. If we were doing hospitality, like take a hotel, we would look at airport statistics to see if the airport was having more or less or stable travel trips through that airport. And so and then you could look at like Smith Travel Research was a good analytical base to show RevPAR, occupancy, and rate for the lodging industry by submarket. But I'm curious, what are some of the key analytical factors that you would take into account in assessing a market as overvalued or undervalued?
Right, and that's a great question. And again, like this is referring to the residential housing that's being assessed here, and so really, so rather than like commercial, like hotels and like retail and so forth, and yeah, so what I have done at RealtyQuant, so it's a study that I did at the beginning of COVID for what is called market valuation. So market valuation is the concept that you can estimate, kind of do fundamental analysis similar to in the stock market in real estate, and you can kind of like estimate how over, under, fairly valued different markets are compared to their fundamentals. So now the fundamentals for the housing market, so to say, are, broadly speaking, income, population, and housing supply. And so those are the fundamentals that we track at RealtyQuant, and we kind of estimate, we give a percentage of, is this market, let's say, 20% overvalued, or is it 5% undervalued, and things like that. And what is important to say, it's a very statistically tested measure. So it's not something like, oh, that's just our model and it works in a weird way and so forth. It's more like it's back tested against the previous 3 recessions. So including global financial crisis and, for instance, 1990 recession is a milder one. And I can show actually, like if you guys, for whoever is able to see the video, I know this is going to be on YouTube and Spotify, I believe. If I'm able to share a table, it perhaps might be easier too.
Yeah, let's go ahead and share the screen. I think the lion's share of the audience will be on audio, but this might be a good episode, guys, to grab us on YouTube. And then now Spotify has video, so if you're listening to this on Spotify, you should be able to see the video, but I'm confident you'll see Stefan's video presentation if you're watching this on YouTube. All right, let's see it.
So market valuation is a concept that's like to track deviation from the fundamentals of income, population, and housing supply. So that's something that RealtyQuant would produce for like around 2,700 US counties. And so this is like a high-level table of like US states valuation at the end of the first quarter of this year. And so this is, it's sort of what it's showing. It's like a few of the Western markets, they kind of ran overvalued, kind of with inflation, and it very much accelerated in 2021. So it actually, US real estate was quite fairly valued before that, and that was a consistent, also across like Bloomberg Economics, for instance, they issue kind of like measures for like the countries and so forth, and they also had the US as fairly valued even up to the beginning of 2021, which is quite interesting. But it did start changing quarter after quarter after this, like with the coming of inflation, that did not get reflected in fundamentals. So for instance, incomes didn't increase so much, and so that drove some of the Western markets, very notably Idaho, like very overvalued. And on the other hand, like there's the Midwest and Northeast and so forth, which are still like under to fairly valued, and those are less booming markets, naturally, and that is quite typical ahead of recessions. So as I mentioned, they've done like studies for the prior 3 recessions, and ending with GFC and the preceding 2. And so that's actually what typically happens, that the correlation of how overvalued markets are and their performance towards the end of the cycle increases a lot. So it's a question of like whether we would have an official recession or not. It's unclear, but if we do, then those are kind of predictive. Then those measures have a predictive power of declines post-recession. So to illustrate that, here is a table. I just want to make sure, Ian, do you see like I have like a sheet with a lot of numbers, and I'll try to kind of relate for the audience listening actually what I'm showing there. So what I'm showing is a table of how overvalued different metropolitan areas in the US were at the peak ahead of 2 recessions, ahead of a mild recession, which is considered a mild recession, the 1990 recession, and ahead of a severe recession, which is the global financial crisis. And then I'm showing like for those differently valued markets where some of them are overvalued perhaps 50% and more, some are perhaps 10% undervalued. And so for those differently valued markets, what was their price performance over the subsequent 10 years, over the subsequent decades? And it's extremely interesting to see, like, because this is both a mild recession and a severe recession. And the first point to illustrate is how overvalued the market was and how much it declined peak to bottom within a recession was extremely correlated. So in the global financial crisis, so if you look up, for whoever is able to see the video, they would actually see how a market overvalued greater than 80%, and those are MSAs, those are metropolitan areas, had an average decline of 52%, while a market overvalued less than, or undervalued to a point less than minus 10%, was actually saw a decline of only 4%. So that was the observation. That was a study, like I've spoken on it, like as early as 2020, in terms of how global financial crisis declines were predictable in magnitude by valuation, by market valuation. And so that was quite interesting. So actually markets at the time that were undervalued, they declined very little, and the average decline was around 4%. And so that correlation was very high. Now, in a very mild recession like 1990, it's extremely interesting because 1990, most people don't even know of real estate declines. Like if you take the broad U.S., let's say Case-Shiller index or something like that, there's like a 0% decline to U.S. real estate. Now, the reason for that is U.S. real estate at the time was broadly undervalued. Now, that said, if you break it down by regions, there were regions such as metropolitan areas or states, counties, etc., which were overvalued at the time, and those did decline. And so it's interesting how it happened. So, for example, it's like markets that were, 50 to 60, metropolitan areas that were 50 to 60% undervalued, they experienced only a 14% decline. Now, that's way milder than in the global financial crisis, where in a severe recession where pretty much the decline was as much as the overvaluation. If something is overvalued by an amount, that pretty much is as much as it declined at the time. But in a mild recession, so a market that's overvalued, let's say 50%, it only declined 14%. But there is a question of relative performance, and what I'm trying to get to for investors right now, because if you look at like right now, where some U.S. states, like if we take Idaho being overvalued 54%, or perhaps Arizona at like 35%, and that's like, again, that's relative to the fundamentals of income, population, housing supply within that state or market. And so if we have a market overvalued like that, and we have a mild recession, and so I feel like I speak to a lot of investors, syndicators in some of those states, and they tell me, okay, what we expect is perhaps we get like perhaps even if the market is overheated, let's say it's going to get a small decline, maybe it's going to get 5-10% decline, and then it's just kind of, I feel like the expectation they're just kind of going to keep along. That's not what the data suggests in terms of what happened historically over the past 45 years of previous recessions, because what seems to be the tendency is, it's not that market experiences a small or a large decline, it's that overvaluation that it has, it's gonna ultimately make it to underperform. And so that's what I'm trying to show in a table with like a lot of numbers that is basically showing how a market overvalued 50 to 60% over a decade ahead, appreciated by only 16%.
So for those that aren't seeing the spreadsheet, which is fine, I do encourage you to look online, but I'm going to paraphrase and you just stop me where I'm wrong. So it looks like you'll go into these markets and your software and analytics will look at population, supply of housing, income, and trends on all of these. Population up or down, housing supply up or down, incomes, household incomes up or down. And it will also look at the 3 previous recessions and or downturns. Obviously the 08 was severe, and then you reference mild 1990s. Did I catch the fundamentals of the analytics?
Yes, exactly. Yeah, absolutely. Okay. Yeah. So yeah, it's just basically going to look at the fundamentals that you mentioned, look at how much prices are deviated from that, and try to derive a measure that predicted the declines for previous recessions, that had a high predictive power. Because if it didn't have a high predictive power, it's useless. And so that's actually what it was. And so deviation from fundamentals was predictive. It's not so surprising if you think about real estate. It's a very fundamental asset, right? It's not like the stock market in 2022, which is highly technology driven, and with companies that are such as Tesla and so forth, which are very hard to value. And so fundamental analysis works less and less in the stock market, It's just difficult to get things right, in my experience. But it's a person kind of coming from a financial background, but in real estate, it's not. And so many people tend to think real estate is like extremely hard to understand the market side, and it's almost as random and stochastic as the stock market is, but it's really very driven by income, population, housing supply.
Well, your interview here on our show is appreciated because you are right on topic with our frothy recession or pre-recession timing of this recording. We're recording this at the very end of August. It'll probably air early September. But this is the kind of information that a lot of people need to consider assuming you continue to invest through this cycle. Now, I myself like to believe that, that myself and as a company, we can invest in all cycles, but you might not invest in all markets in all asset classes. So to your point, there may be winners and losers, and there usually are winners and losers in economic corrections. So do you mind, you mentioned Arizona and Idaho as a couple of examples of overvalued markets.
Correct.
Based on population, housing supply, income, and layered with what happened in the 3 previous corrections. Do you mind giving a couple examples of places that you think might be undervalued?
Yeah, absolutely. Undervalued at the moment are again, they're just sticking to a state level for timing, and we can discuss cities as well. Is states that generally did not perform strong as well. So those are places like Illinois, North Dakota, Louisiana, West Virginia, Connecticut. So there is also kind of around fairly valued like places in the Northeast where there isn't much investor demand, such as New York, Pennsylvania, New Jersey, and some place in the Midwest, Kentucky, Indiana, perhaps kind of in a relatively fairly valued range. So those are not, it's important to note, those are not kind of sexy markets, or the markets within those, like the cities within those. So we can discuss 2 cities where, I guess, so in my data, most overvalued cities kind of being, and this particular test is kind of based on county data, but we can get to the MSA level as well, and it's and so the most overvalued kind of cities being Boise. So Boise is kind of consistently observed amongst Moody's Analytics. There's a study at Florida Atlantic University, and what will I have at RealtyQuant? It's just consistently across. In my data, it happens to be like 800 cities. It's at the very top. It's the most overvalued city in the U.S. And so that's one. I mean, Austin, Phoenix, Tampa, at this point are overvalued. There are a few other cities. In the undervalued. Well, San Francisco, San Jose, Chicago. Places like that have not performed too strong. But it is extremely interesting question to look for how are they going to perform ahead. So one thing is, so those undervalued markets, let's say, they were not so strong so far. That's how it typically is ahead of a recession. They stayed a bit undervalued because they just didn't get overheat. Nobody wants them so much as far as like huge investor appetite. But the question is, what if they actually outperform ahead? And that's like extremely interesting if we are already past a recession. And so that's what the table, kind of with a lot of numbers that I'm showing, like for audio listeners, is suggesting that the markets, that if we do have an officially declared recession, what happened in the past in both a mild and severe recession, such as 1919 global financial crisis, that markets that were less than like negative 10% and below undervalued, they actually outperformed all the other categories. And markets that were overvalued 50, 60%, they were the worst performing ones, or the most overvalued ones were the worst performing ones for a decade ahead. And so that suggests like the need to reallocate capital for institutions and let's say mid-range private equity funds that purchase assets in. And again, like to clarify, this is very much based on just broad housing data. So it's actually not commercial multifamily, it's not cap rates. And I've looked into like theoretical cap rates forecasting and things like that. It's some kind of, just purely kind of intellectual exercise, if you will. But it's not, it's not what is covered here. This is the housing market. It's just the broad housing market. So it's there's always differences versus commercial multifamily. But like in my view, like there is a need to kind of reallocate capital away from, if you think of what have been the most booming markets now in price appreciation, and I do have the appreciation in this table as well, but they really have been to the west and to the south, as most of us investors know. It's been, what is the top performing state? It's also Idaho in price appreciation. We have Arizona, we have Nevada, Utah, Colorado, all those western states. We have Texas and Florida. And so those have been extremely well performing. But what the table of like 10 years ahead changes, at least in prior recessions, is suggesting is that if those well-performing western, it's basically western and southern markets are overvalued to a given percentage of, let's say, 20 to 50%, which they are at this point, we would likely see a shift where in the next decade, Western and Southern markets will no longer perform so well. And that is extremely statistically likely. It's going to be very, very difficult for that not to happen. If we haven't officially declared a recession, then if we don't, then they continue doing well, because the real estate is very momentum driven, and that's been seen very well. And even if they're overvalued, they would continue appreciating. And that's happened between 2020 and 2022. And that's what happens in other countries, such as like notably the scans economies is one interesting example. That's Sweden, Canada, Australia, Norway, New Zealand. So they've been reported by, there's a study at OECD, and there's also Bloomberg Economics, to be overvalued as early as 2018. And Canada has extremely overvalued real estate even at the current time. And perhaps prices slightly reduced. Very little, and that was like due to those countries being kind of like small, closed, commodity exporting, oil exporting economies, and the central bank is related to like 2014, 2016 oil crunch, cutting interest rates, and so that was, and so those are like very overvalued markets as early as 2018, but they continue doing well, and they continue being overvalued unless there is a trigger such as interest rates increasing or other triggers we may be seeing like in the current economy, in which case, okay, now suddenly this stops. And that has been the case with Boise as well. So with Boise in Idaho, that was overvalued as early as 2020 to a much lesser extent than now, since like US real estate was actually fairly valued at that time. And to a much lesser extent, but still overvalued at the time. But it continued running and continued going up and up, and so that's the expectation. But I think the important takeaway here is, because I speak to so many investors in the industry, and the important takeaway, what I see is everybody expecting. So the current regime, where southern and western states are doing really well, to say that that's going to change, it's like extremely, that's just nobody can perceive. They would expect, typically investors would expect, okay, if we have a bit of a decline, it's possible, maybe it's overheated, maybe we get a 10% decline. But that market afterwards picks up and kind of continues chugging along, That's not what the data suggests. That's not what happened ever in the past for a market that's 20 to 50% overvalued. It actually underperforms even very mediocre markets. And so that's what like this table is showing. So it's showing that markets that were, let's say, 20 to 50 or 60% overvalued, even in a mild recession, they heavily underperform. And it's very interesting what happens to them in a mild recession, because many people say, okay, the question is, if we have something that's overvalued first, is it going to stay overvalued is the first question. I've had many friends ask me, can the markets overvalued stay overvalued? The answer to that is no. That never happened. There's like over 4 to 5 years of history, something that's overvalued. I track like those measures historically for the full period. They always converge to zero. They actually don't only get to zero. They typically go to slightly undervalued at the bottom of a cycle. And so if something is even plus 80%, it's gonna go to zero. It most likely will go to like -5, -10% towards the bottom of a cycle. The question is, how is that gonna happen? Is that gonna happen as a result of a significant price decline, or is it gonna happen in a mild recession with a very small price decline, such as it was for markets 50 to 60% overvalued in 1990, which declined only 14%. Yet their 50 to 60% overvaluation did resolve and it disappeared. And through like 1998 or 1996, as early as in some of those markets, was fully gone, and it was at zero and in fact negative. And that the reason why that happened is in a mild recession we have strong economic recovery, and so real estate typically doesn't really crash, quote unquote. Even if we have something like a global financial crisis, the declines, they take a long time. They took like 4 or 5 years in most markets, and people who are able to see the table, they can see the table. They are able to see like average decline duration in like different buckets, and it's like 5 years for many of them. And so it took a really long time. It took like between 2006, 7 to like 2011, 12 to really hit the bottom. And so over this period of let's call it 4 years or 5. So over this period, if the economy has a weak recovery, those overvalued markets, they end up basically declining as much as their overvaluation, or kind of having a big hit. That's what happened in the severe recession, global financial crisis. If they don't, if there is a strong recovery, if there isn't a weak recovery, if there is a strong recovery and it's a milder recession, what happens is they decline a little bit. So it could be a market's 50% overvalued. It's going to decline only 15. And that's because, but that decline is going to be a long, painful time ahead. So that 15% is going to be, as was, for instance, after 1990, taking as much as, on average, like 6.5 years forward. So those kind of durations is something that I feel like many investors also don't understand, where they feel like if we're in trouble now, if we don't even have an official recession yet, but if we do, okay, it's just something sort of happening right now around the current time. It's not the case. It changes cycles. It has a bigger duration of declines, and that duration is there even for mild declines. And the milder the decline, perhaps the longer the duration for a very overvalued market, just because it takes longer for it to come down to its fairly valued state.
And thank you for that. That was detailed, and I can personally attest to the duration of recovery, because I was appraising in the go-go days of 2007, proposed hotels and apartments, non-recourse loans, 90-10 loan to value, just boom, there you go. And when everything fell in the fall of 2008, we were still seeing bank-owned, deeply discounted dispositions, so bank sales, well into, so that's fall of 2008. 6 years later, I was still brokering deals straight from banks to investors at 50, 60 cents on the dollar. I personally sold what did I do? I did a 2010 built Candlewood Suite, so a nice IHG extended stay product. It opened new construction in 2010, horrible timing, but they closed their loan and they had to build it right through the beginning of the recession. That property sold in 2014 or 15. It was still in like new condition, but it was like 45 cents on the dollar. And they threw in a vacant parcel next to it. My only point with this anecdote is, it's true. Let's say we do go into a recession, and I personally don't think it will be as severe as 2008, because of why it's happening. That's a whole nother podcast topic, but it's going to take years, in my opinion, if we slide, for that to correct and rise back up. Is it going to be 4 years, 2 years, 6 years? I mean, in the last recession, we had discounted pricing well into, go pull sales comps in your local market from like 2016. That's 8 years after the fall of 2008. Go pull comps in your neighborhood in 2016, and you are going to just be shocked. You might see stuff at half the value of, what your local broker or Zestimate is going to tell you today. So just to your point, Stefan, the recovery period can be long, and to make an actual actionable point out of that statement, if you're sitting there watching or listening to this show today and you're wondering, when are the really deeply discounted deals going to come? I would advise you not to feel like you're rushed, because the truth be told, and that's a big if we have a slide, and that's a separate discussion how far it goes and everything, but if we have a slide in real estate pricing, there's probably a fairly broad window of time where you could go in there as an investor and make your money. I feel like there's a lot of people now that are like, has it happened? Is it happening? Are sellers panicking? Should I buy now? Should I buy now? And my answer would be to just chill, go meditate, sip on some coffee, and it'll be clear when prices are truly sliding. I'm in Florida right now, and there's more listings. I'm just going to speak to residential because the stats are fast and easy. There's more listings coming into the market. So inventory is up, and that's largely because the residential seller is afraid they might be missing the boat by not selling in this market. And truth be told, they already missed. If you were to sell your property like around January or February this year, you would get likely more money. You would have had multiple bidders, lower interest rates, you probably would have got more money. Now, what we haven't seen yet are closed sales, so actual closed transactions showing a year-over-year decline in my markets yet. Now, you do have more listings, you do have more people falling out of contract, you do have higher rates, you do have a smaller buying pool because of the rising rates. So I do think it's just a matter of time to where the stats finally lead to a decline in prices. Because eventually you're going to have sellers that are like, I don't want my house to sit on the market for 90 days. I want it under contract in like 30 days or less. And if that means lowering my price, then by God, here we go. And so that I haven't seen that happening yet, but it's starting. It's just starting, and it will lead to closed transactions at a lower price per foot. And once those closed sales happen, as you know, on the analytical valuation and appraisal side, once you have closed sales within a submarket at a new lower price per foot, that's going to be what the next guy looks at, and the appraiser looks at, and the bank underwriter looks at, and then it just trickles down. So I'm just kind of waiting to see that happen.
Right. And yeah, you made a great point on the, I completely agree with the durations aspect. And even in a very mild recession, just to keep in mind how long the duration is, that kind of the table suggested, depends how much overvaluation we have. If we have no overvaluation at all, the duration of decline could be as short as 1 year or 6 months or something like that. And that was well shown in the table. If we have a significant overvaluation and a very small decline in prices, that very small decline could be well happening over 6-7 years. And so kind of the market becomes super stagnant and kind of declining. And so, but really to me, like the question is more, the way I look at it, it's not like a doomsday kind of perspective. It's more, where should I allocate capital and which market is going to get the highest appreciation. So in that, my expectation was, having done some of those studies before, but not done, for instance, the table that I just showed today, my expectation was that we're going to see the highest appreciation in fairly valued markets. Because fairly valued markets, they have strong, decent fundamentals, average kind of fundamentals. They've performed decently well already. And so why should that change? Why should they, underperform relative to undervalued markets, which are extremely weak at the current time? And so what that study suggests, that I showed like in the table with like a lot of numbers, basically is that actually, no, it appears in both a mild recession and in a severe recession, the place to allocate capital appears to be in the most undervalued bucket. And that's extremely surprising to me. And the place where to not allocate capital is, the current extremely booming markets, which is, not surprising to me, but still surprising to many people who, if I say to someone that Phoenix, Arizona is extremely statistically likely to not perform well over the next decade, they would find that's like a crazy statement. How is that possible? Because they would think, okay, if Phoenix, Arizona is overvalued, it's going to decline a little bit. Let's say it's going to have a 10% decline. But that's a question of, okay, it's overvalued, just corrects, gets a small correction, then continues chugging along and doing really well. But that's not what happened before. That's the bucket of greater than 40% overvalued metropolitan areas underperforms other buckets, other valuation buckets, even in a very mild recession. And it underperforms for a decade ahead. And that's what people don't understand when it comes to investing in some of the markets, that if you already invest in that valuation, it's not the time to do it. Assuming we get a recession, any officially declared recession in the future, even if that's a mild one. And so it's a question of just capital allocation and relative performance, and not so much a question of only downside risk that then comes back, and then that market is going to decline 10%, but then it's going to go up 50%, and that's going to be the best market always because it has the best fundamentals. That's what people think. It does have the best fundamentals, but those fundamentals are simultaneously exceeded by 40% already. So if it has housing shortage, that's reflected. If it has population to housing square ratio, that's reflected in this measure. It has like income levels of certain level that are based on and population increasing and relative to its housing supply, so it's reflected. And so that's kind of like the real question. The real question is relative allocation. And so what this is suggesting is it's relative allocation towards undervalued and not even fairly valued markets, which was my expectation. And so that's a big finding, because that's just where institutions are even now invested in. I mean, I was offered a project to be GP on in Arizona, and I had to turn it down. It's an incredible project, great, very good returns and so forth. But I cannot do a project in Arizona because I look at the data, it's just not going to happen. I don't care if it's been the most booming market so far. It's not going to be in the next decade. And that is a very, very statistically likely thing.
Well, I appreciate your transparency. I mean, you're naming specific markets. You're telling us specifically what you would or would not do. And some people don't have the fortitude to say that on a podcast. But so I appreciate that. If we had, we don't have a crystal ball or crystal balls. But, if we could go take and it's still pretty, especially let's take multifamily, still a very hot multifamily market. You still have some of the best debt structures and probably the most appetite with like institutional investors commercially for multifamily. If you could right now, maybe you sell Tampa, maybe you sell Phoenix or Scottsdale, and you park that capital outside of Chicago somewhere, and then you watch Scottsdale, Phoenix, Tampa, Boise. You watch these cities slide. Even in a mild recession, like you said, you're still going to have pretty severe price sliding in the overheated markets we just referenced. And then maybe you go out of Chicago and go back and buy, Arizona at 50 cents on the dollar.
Well, right, but it's not. They didn't have a severe price sliding in a mild recession. In a mild recession, they had a pretty mild price sliding. It's just that price sliding, if it's mild, it continues for very long, and they end up underperforming. And so it's not a question of. I think what a lot of investors that I talk to are not understanding is the likelihood of something like, let me put it, even Chicago outperforming Phoenix. And that's a very counterintuitive. That's the concept of even getting that the weak fundamentals market is going to exceed a very strong fundamentals market, such as Phoenix. That's not something investors are able to get, but it's extremely hard to not happen if we have even a mild recession for a market that's already 40% plus overvalued, such as Phoenix.
Yeah.
It's just a big chunk of valuation to overcome, even if it's stronger fundamentals. And so that's at least like kind of having markets bucketed into those groups and seeing how the different categories performed. It's a question. It's not. I personally don't so much care how much Phoenix declines or doesn't decline. This is not a decline question. It's more like where is it going to be 10 years from now and forward or so forth in the long run. Is it going to be, what is going to be its performance? And again, in a mild recession, it's going to decline a little bit. It's not going to decline much. I think that's what most people are expecting. It's going to be like 10%, 15%, something like this. But again, its performance would be affected just the same. Whether it declines 15% or declines more, its subsequent performance and coming back to fair valuation would be roughly the same. And so that's kind of that's the issue. For me with this, it's basically it's hard for me also as an investor to understand how a very how something like San Jose now, or San Francisco that is not doing well, that's doing terrible, it's losing population and so forth, appears to be statistically likely to outperform Phoenix and to outperform Boise and to outperform, Tampa and so forth. And but it is how markets work. It's the cycle of kind of like the cycle of markets, and that's why it's extremely important to track that. And just to clarify, like that's not like, let's say, like it's not so much an opinion as it is. I mean, the correlation of valuation to declines at the metropolitan level, valuation to subsequent declines during the global financial crisis was 89%. So it's a very high correlation. That's predicting the future. That's not like some kind of spurious regression of something that's two variables moving at the same time or something like that. That's actually the number valuation at the peak ahead, and then a decline that happens over 4 or 5 years, and it's so fundamental and it's converging that those 4 or 5 year ahead developing figure is correlated to the prior one to 89% correlation. And so that's kind of like that's the side. I just try to bring it kind of to people as something new. It's another metric to look at, because it's just it just changes how you analyze markets rather than looking at just their growth fundamentals of job growth, population growth, so on and so forth. It's more like you need to understand that, but you also need to understand pricing and by what exact percentage pricing deviates from that. Because if you have extremely strong fundamentals, but pricing is very deviated from that, you will still underperform in the long run. And so you need to not buy markets at a premium. It's sort of the way like real estate investors, they buy properties at a discount, they do it really, really well. They're kind of Warren Buffetts of property investing. Everybody, pretty much, right? You buy always at a discount. It's done really well in the industry. Or let's say, if it's not a discount, kind of a value add that you realize, forced appreciation and so forth. But it's not done at the markets level because there just isn't knowledge about it. And it's kind of a little bit more of a finance kind of domain. And so it's not favorable post-recession to buy market at the premium. And so that's the whole kind of thesis there.
And I know your analytics they pull largely from residential statistics,
correct,
plus previous recessions, population trends, and income. One insight I'll layer on top of this conversation from a commercial standpoint: cap rates. And the cap rate is just, it stands for capitalization. You convert the NOI into a property value. Well, normally the cap rate it's your unleveraged rate of return, NOI on asset price. If that doesn't make sense, don't worry about it. But what does matter is the cap rate is also an indication of risk. If we're paying a low cap rate, that means we're paying a high price. So what used to happen, because bear in mind, I've been in valuation for 16 years, it used to be that a C-class apartment, let's pick where I am. I'm in Jacksonville. It used to be a C-class apartment. Let's go all the way down to a D-class. That's a rough property in a rough area. That property is probably going to be like a 10% cap rate, meaning if it has $100,000 NOI, it's $1 million property. Well, then what happened is all of a sudden, and then a C class might be a 9, 8.5, and then a B class might be a 7 to 8, and then an A class might be a 6. Well, now you've got investors that'll pay, like a 5 cap for like a low C property. So what you've really done is, the investors that can't quite afford, what's now like a 3 or 4 cap on a Class A property, they're like, well, I'll just go buy a Class C or Class D property in a maybe not so good neighborhood. Maybe it's built in the 50s, 60s, 70s, metal pipes. It's going to need some work, but I can afford that, and I'll do that at like a 5.5 cap now. Well, that for years and years and years, that was like a 9 or 10% cap rate property. So to your point, when you start to see people paying, but you can see it in the cap rates. When investors are willing to go either down the asset class scale and start paying like the same cap rate for a C or D that they used to pay for an A or B, or another example, let's use location. Let's move off of cap rate in case that's confusing people. When you start seeing people paying the same cap rates or price per unit for like a tertiary market, like I'm in Jacksonville. If I go out and say I go into like Southeast Georgia, I currently own a property in Valdosta. That's not a large market, But people are starting to pay. They're not paying Atlanta prices. They're not paying Jacksonville prices. But they're starting to pay prices per unit and cap rate that you would have never seen in a smaller tertiary market for a C-class property. So I think to your point, you got to watch out for these overheated markets because they tend to take a big slide. You also can't go into a quote-unquote fair market and value it as if it's a hot overheated market, because some people are starting to do that now. They're paying as if they're paying like the overheated prices minus a little bit, but for a market that is not a premium market and for an asset class that is not a premium asset class. And I do think that whatever happens next, some of those buyers are going to get burned because they're like, oh, I'm paying a better price than I could get in, Atlanta, Jacksonville, Tampa. But you know what? You're like in middle of nowhere, Georgia or Alabama with a population under 100,000 people, and you just paid like a 5 cap, when rates are rising. So some of these guys that went tertiary but didn't take a big discount in their pricing for going tertiary, I think they're also going to experience some pain in the next few years.
Right.
All right. Well, we're kind of coming up against the hour, which is just out of respect for the audience, where I try to cap things. I noticed your website. You do have an online course. Do you want to speak to some of the products you offer and where people can find you?
Right. Yeah. So RealtyQuant.com is my website. So that's the best way to reach to me. We do offer market valuations data. So some of the things we spoke about today, so in my view, are best addressed by kind of having the data yourself and looking at it, and for your markets and so forth. So we do offer that as a product. I also released a commercial multifamily product on the property side, kind of like property data. And I do have a course on data-driven investing if people want to sign up. I think it's starting in October. So it kind of teaches you like different like technical tools for investing, real estate investing on the property analytics side, on the market analytics side, and so forth.
And just to restate, that is RealtyQuant.com. So Realty, QUANT.com. And I did go on the website before we recorded, and you can find Stefan's digital course, links to his different analytics and other opportunities. So I personally found you to be a fascinating guest. I know some of this, might go over the head of an average listener, but it's still good to hear this, start hearing about trends and thinking about where you're investing and thinking twice about some of the statistics. Really dig into the statistics and look more broadly. I love the fact that you're looking back through 3 market corrections. I don't know anybody else kind of aggregating the data of 3 previous recessions and then overlaying it from population, housing, and income trends. So I applaud your efforts. And a lot of what you said today was counterintuitive to how market participants are behaving. You're right. There are a lot of people that are like, I'll buy Tampa, I'll buy Miami, I'll buy Phoenix, I'll buy Scottsdale because everybody's moving there and the fundamentals are so strong. And if it slides, it's only going to be a mild slide. And what you're saying is it may or may not be mild, but it's probably going to be a very long slide, and it may take you a while to get back to where you were, certainly this year in January, and probably even if you bought it today, even when the show airs. So I appreciate you coming with like a somewhat countercultural message on markets. All right.
Exactly. Thanks, Ian.
Yeah. All right. And Stefan he's active on LinkedIn and on YouTube. What is your YouTube channel? Is it RealtyQuant?
No, it's called Finance Meets Real Estate. So that's a webinar that I run. So Finance Meets Real Estate on YouTube.
Okay, Finance Meets Real Estate on YouTube. Well, I've really enjoyed this. We'll link as much as we can of your information into the show notes. And as always, if you enjoyed this, please rate and subscribe. I enjoyed it, and this will be on a link on our Instagram, and we'll be on YouTube, Spotify, Apple, and all of your usual networks. All right, well, for now, that is the Yield Coach Show, wrapping up episode 21. Really enjoyed it. Everyone go out there and lace up and leave it all on the field. Coach Brown, out.